Here's a look at what happened with the stock market today, but more importantly, what's going to happen by the end of this week. The stock market took a bit of a sell-off today. Bond yields rose significantly off the back of last week's economic data. Economic data came out on Thursday, which was basically a Friday for the stock market. They did their 3-day weekend and now they're back to work. Bond yields rallied, sending stocks down lower. What will happen on Friday with non-farm payrolls and unemployment? My thinking is not a whole lot. We're at about 3.7% unemployment rate. The high interest rates we have been seeing over the period of the past couple, at this point, 9 months or so till they peaked out where they are now, the Federal Reserve, they're not really having that big of an effect on the economy itself. The economy itself is growing significantly, but with 3.7% unemployment rate, how much more room is there? Not much. Given that, I don't expect a huge move on Friday, given what we could see with non-farm payrolls, which might come in right around what expectations are and kind of be a little bit soft in that regard. Let's jump in. I'll break down the charts for what happened with the stock market today, showing you what to be looking into, keying into, going into Friday, and what I'm doing to get ready for Friday's number. Let's jump in. All right, a couple quick announcements before we jump into some economic data. For those of you who've been following me intently for a little over 3 years now, thank you so much. Regrettably, I am going to shut the website down. I'm transitioning everything over to Substack. I'm just trying to make my life a little bit easier. The content that I was producing on that channel, YouTube is basically saying not no, but absolutely no. Basically, we'll just put it that way. Once again, I got stopped out all through September, October, November, December, January, and into February. And finally, they said, we're reviewing your channel entirely at this point. So I'm done with that content. Incidentally, I had launched this channel, so I'm going to continue with this because this doesn't offend YouTube's census. Regardless, there is a link down below for my Substack. Again, if you are a follower, all that's going to transition over. It's just going to take me about a couple weeks. I'm going to do it very slowly. I'm not in any kind of rush or anything like that, but everything will be transitioned over. I did take about 18 days off here for maybe a little bit longer. I had some other things going on that didn't even quite finish nonetheless. So let's jump in. So PCE, personal consumption expenditures, we get three key data points we got last Thursday. Last business day of the month is usually when it comes out. Personal consumption, personal incomes, and then the PCE deflator index. Personal incomes. Now we're looking at the personal income number here. This really drives everything when it comes to my analysis. And I do have a written analysis on my Substack channel. I've had that channel for years. I just never really kind of took off with it. But I did post something on that today, so make sure to hit that link. That data is, or those postings are actually free. There is a premium subscription. But breaking this down, this is where I start my analysis. Personal incomes. And what we're looking at is the rate of growth, the year-over-year changes in personal incomes. We see bigger fluctuations with employment than we do with, say, government expenditures or business expenditures. Business expenditures, of course, follow the trends of the overall economy, but it's really the number of people who are on the employment numbers, the payrolls, and the amount of money they're making. We're looking at the year-over-year change. As incomes grow on a year-over-year basis, so do expenditures. That converts into revenue for companies. So this is where I really start my analysis. And as you can see, we're below median for year-over-year rate of growth. That's not a number that's really sort of problematic, but there was a small dip in personal expenditures, a tiny dip. We had hit the median number just last month and small slide a little bit lower. We'll probably continue to see a smaller decline more and more going into, say, the summer. Now, I looked at, I put out a video a little while ago, back in November, I think it was over Thanksgiving, I put this video out where I kind of predicted what I thought was going to happen with the stock market for 2024. And my thought was we would see a rally going into the spring, lull out during the summer, then a sell-off in the fall. And so far, everything's playing out as I expected. We'll see how that plays. Again, expenditures, the rate of growth of expenditures does drive the rate of growth of revenues. We're at the median. Slight decline. This really won't propel too much employment going forward. There's not that big of a move at this point. But the real sort of number that we've been looking at is the Personal Consumption Expenditure Price Index, PCE Price Index. This is the Federal Reserve's favorite inflation deflator. We saw this. We get the CPI about 2 weeks prior, so we get a heads up as to what the PCE is going to look like. They're very similar. The PCE is slightly nuanced to be a little more sensitive. The trend is working. Unfortunately, and here's the core PCE. This one excludes food and energy, which I do have a chart coming up on oil. We've seen increases in the more volatile food and energy. Oil prices are heading higher. Have you seen cocoa touching 9,000? Ridiculous. Core PCE, however, 0.261 month over month increase. Multiply that by 12. That gets you about 3.25% for growth annually. But that doesn't include compounding. That's such a key thing. We're not going to get there at the current rate. What I think is probably going to happen, though, is the economy may slow down simply because how much more can you cram into this? We're not going to see too much in the way of employment gains moving forward. We'll get that number this week, and it might be starting to soften a little bit because how much more is there that we can push 3.7% unemployment rate? We would just be getting to moderate levels, but that might be enough to top the stock market lower. Here's a look at, this is the 1 hour bond, U.S. government treasury yields, the 10-year. This is your benchmark investment rate. This is the one I gravitate to all the time. This is the measuring stick right here. Not much of a move last Friday. Everybody might have, last Thursday, everybody might have actually been on vacation already, taking a 4 or 5 day break. They got back to work today. We might see the 10-year trickling a little bit higher over the course of the next couple weeks, but I don't really expect we'll see 4.5%. I'm going to start taking moves on that with one of my favorite ways to trade U.S. 10-year Treasury, of course, is the TLT ETF, which is the Treasury longer dated 20 and 30 year plus. Here's a better look to encapsulate the U.S. 10-year Treasury. Again, I don't think we're going to probably cross 4.5%. We might top out around 4.4% given where we are now. But it might be that the Federal Reserve needs to lower interest rates, not because they've achieved their goal, but because this economy might sputter out somewhat. Again, I'm going to keep repeating this, 3.7%. How much more can we go? We'll see how that plays out. In the meantime, stock market, here we sold off a little bit. It was only about 0.25%. We had been higher after hours, which you can see from the top of this chart, that we hit for the S&P 500, we hit a new high, but then it sold off all day as bond yields moved forward. The thinking was everybody front run going into Monday today, not realizing that the bond yield was going to rally like it did. Overall, this rally is still intact, but I'm starting to question and wondering if my analysis back in November is still spot on. I expected we'd moderate throughout the summer, typical for the summer, but then start seeing some selling going into September, October, November, December, as everybody who's on summer vacation comes back and gets back to work. I just don't see employment gains pushing the economy further, that we might have just reached an exhaustion level, which would force the hand of the Federal Reserve to lower interest rates, not because they've achieved their necessarily their goal with 2% target, more so that employment increases are probably going to decline. All right, the VIX. Got a little pop out of the VIX today. I like trading the VIX a lot. I think we're probably going to mellow out here for some period of time. I don't expect a lot of movement in the VIX. We spiked up to about 18 a little while back. in February, I don't think we're going to cross into those kinds of numbers for some time. What I'm doing is I'm stepping in. Once VIX drops back down to about 13.5, I'm going to be starting to sell the puts on, say, UVXY stock, one of my favorites to get in there. But I probably won't be selling any calls, especially going into Friday. We might see a little bit of a spike from Friday's number. I'm probably going to immediately thereafter sell some calls at that point on UVXY stock. Oil starting to trend back upward. We've got a lot of supply and demand issues that are kind of working their way through. OPEC has been doing everything it can to slash production, but I don't necessarily think that oil is going to continue higher and higher, simply because what I think is likely to happen is this economy starts to slow down on its own. Demand for oil will decline. China, of course, is having their own issues with their domestic economy, and that could keep supply elevated, which could keep prices lower for oil. Gold, all-time high. I'm a silver bug myself. I tend to hold the physical stuff I just stack it up. I've got a bunch of coins for silver. Don't have a whole lot of gold. Nonetheless, I think we're probably going to get to a point where gold, the price of gold, will actually move higher if the Federal Reserve is forced to move its hand lower. But at the same time, if you were to overlay gold, the stock market, gold, and then say Ethereum, over the past 9 to 12 months, ever since about a year now, if you were to take those charts and look at them over a longer period of time, we've seen assets elevate significantly. And I think they're kind of sputtering out. So on the one hand, gold could continue higher if the Federal Reserve does lower interest rates. But on the other hand, people might take profits on their assets. So I'm going to keep a sharp eye on gold because of what's going on there. US dollar index, as interest rates move higher, the differential between what's going on here in the United States versus, say, Japan or Europe, that differential, what they're going to end up doing is taking their money, putting it in the United States because they get a higher yield. It's called the carry trade. This will, as if we continue to see interest rates moving higher, the dollar will follow suit. But what I wanted to take a look at, of course, Thursday, we're going to get continuing claims and initial claims. Here's a good look at them. The two on the right-hand side, those are your sort of shorter period of times. The continuing claims, it's elevated somewhat from the past few 2 years or so. But when you look at it in a historic perspective, anything but. We're still considerably lower with continuing claims. Thursday's number will be sort of a hand tip to see what's going on with the employment numbers. And here's a good look at non-farm payrolls. I don't think we're going to see above 200. I'll take the under on 200. I think we're probably going to continue to see the economy moving forward, but at a slower and slower pace. That could propel the Federal Reserve to go ahead and lower interest rates, not because they contained inflation, but because the economy might have breathed its last gasp. That's kind of how I'm looking at it and sort of breaking everything down for the stock market today. Nonetheless, Substack down below. Make sure to hit the link. You can get the free email. I'm probably going to push out at least one posting per week, breaking down the economy broadly speaking, all the economic data we have coming out. And of course, on Friday, we get non-farm payrolls. I'm also going to offer a premium where I do value investing and things like that. Nonetheless, make sure to hit that link. Make sure to hit the like and follow button for this YouTube channel as well. Thanks so much for following along. We'll see you in the next video.